Here's how Democrats might end up soiling Donald Trump's presidency. That is, his entire presidency could end up being labeled a failure by Democrats for something, frankly, out of his control and in part out of Democrats' control as well. But first, let's understand how Donald Trump should benefit the economy, and then let's talk about the real risk factor that right now the Federal Reserve says has a 57% chance of happening in the next 10 months, which is a big problem, and it would be very bad for Donald Trump. But before we get to that, let's talk about how Donald Trump should benefit the economy. First, the Tax Cut and Jobs Act of 2017 benefited about 60% of Americans by lowering their taxes. Kamala Harris likes us to believe that only those making over $400,000 benefited, but that's not true. About 60% of Americans benefited, of course, to different degrees. Some wealthy people benefited to the tune of millions of dollars, and others benefited only to the tune of maybe hundreds to thousands of dollars. But Donald Trump has proposed or argued that he is going to expand a lot of the tax cuts that expire in 2025 and start phasing out from this 2017 plan. And so we expect, in addition to an expansion of tax cuts for potentially vehicle purchases, plane purchases, boat purchases, equipment purchases for businesses, hiring, employee tax cuts on potentially payroll tax cuts, corporate tax cuts potentially even lower than the 21% where we sit now, or the no tax on tips, maybe even no tax on overtime. We might see these tax policies implemented, my guess would be as soon as May 2025. Congress won't actually really get to work until February, and it'll take a few months to pass some form of sweeping tax legislation if they make this their top priority. I think they will, and in my opinion, you're probably going to see sweeping tax changes that benefit the economy, and that impact should be felt sometime by the fourth quarter of 2025 or 2026, because obviously it takes time for you to start actually recognizing some of those tax benefits. Regulation cuts should also help businesses over the long term. I personally think if we're going to have, let's say, Optimus robots or full self-driving vehicles without steering wheels, we're probably going to get that sort of innovation faster under Trump, though I don't think it's imminent. I don't think I necessarily agree with Elon that we're in a 2026, but I do think that under Trump, you probably shave a few years off the time frame as you're able to accelerate that innovation. And companies in the near term might actually avoid bankruptcy, specifically companies like Spirit Airlines, who might merge with JetBlue, because you're likely to get rid of these anti-monopolistic folks like Khan over at the FTC, trying to break up Google, other companies, and prevents mergers between companies like Spirit and JetBlue. So in the near term, you might actually end up keeping more jobs at companies that don't go bankrupt because of Trump policies that make the business environment more flexible and, quite frankly, more conducive towards growth. I also think that Donald Trump's tariffs are much more of a negotiation point, and that the worst case scenario for tariffs has already been assumed by the bond market, that there's going to be all this inflation. I actually think that's totally wrong, and I actually think bonds might be forming a bit of a bottom in pricing right now on fears over Trump tariffs. But I think a lot of this is Trump negotiating. And if the economy continues to slow, I think the last thing Donald Trump is going to do is implement potentially economically crushing tariffs early in his 4-year term. Maybe if we avoid a recession and we get through the next 2 or 3 years, maybe it's more of a second half of his term consideration, but I don't think tariffs are really going to be a big day one issue. Nonetheless, American businesses are rallying. Look at stocks like Tesla up 13% today. John Deere's up 1.3%. Generac's green, Apple's green, Microsoft's green, Tesla, obviously we already talked to 13%. This is remarkable. Caterpillar, these are all American manufacturers, and they benefit from US-based production. The exception of Apple, which obviously contracts out to China, but people see Apple as still an American company that should benefit from Donald Trump's plans, mostly because Donald Trump actually worked with Tim Cook to help exempt a lot of Apple products from tariffs. You could study that history from the 2018 Trump-China trade war, But anyway, Donald Trump is expected to repeal support for the green industry. This would probably take the form of repealing the Inflation Reduction Act. And while everything so far, with the exception of tariffs, which I don't think will come anytime soon anyway, everything so far is expansionary for the economy, the Inflation Reduction Act will probably actually enhance layoffs starting in 2025, which is not great. See, companies like Enphase, which is down 19% at the time of this recording, hires contract manufacturers in the United States to build microinverters. Tesla and Solar Edge and First Solar hire companies or manufacture themselves batteries, solar panels, solar inverters, and they do that in America with the benefit of, quite frankly, Biden bucks to help motivate them to produce these batteries and sell them. See, it's the consumer who benefits from cheaper batteries, but it's also the company who benefits with manufacturing tax credits for building out the manufacturing facilities to make this kind of product. The Inflation Reduction Act is credited for creating about 330,000 jobs so far, that's per Biden, and that's probably overcounted. But if Donald Trump does end up repealing the Inflation Reduction Act at the same time as he passes job cuts, you're kind of boosting the economy at the same time as you're taking from the economy, because you're going to be losing jobs. And now I'm not saying that we need to shill for green energy. I'm just saying you're going to be adding to job pain while at the same time trying to prop up consumers. The problem is the potential for a jobs recession, especially at a time that we're trending towards not the best economic outlook for 2025. You've already got home builders falling. I mean, look at D.R. Horton down about 5%, Home Depot down over 4.5% on the lack of a potential tax credit for home buyers, and a new high now on the 30-year mortgage rate, thanks in part due to markets trying to price in some tariff-induced inflation under a Trump administration, which I do think yields are likely to plummet. Not only because I don't think Donald Trump's tariffs are going to be that bad, but also because of, quite frankly, the giant elephant in the room. And this is what is not Donald Trump's fault. This is what is mostly the Federal Reserve's fault. But Donald Trump, unfortunately for him, is probably going to take the blame for this. We're going to explain this in just a moment, but I want you to think about some of the ironies. Back in 2020, I joked that if Donald Trump lost the election in 2020, he would probably sit out all of the inflation, and then he could potentially, in the craziest irony, come back when the inflation rate is back down. Well, inflation rate when he left office was around 2.5%. It's around 2.5% right now, and it went up to 9% under Biden. Now, obviously, prices are significantly higher, but the rate of growth, that continued expansion of the inflation, has slowed substantially. So you do have this sort of irony. But another irony is possible as well. Donald Trump had to sit through the COVID recession, which fortunately was very short and a V-shaped recovery. But Donald Trump might have another big problem on his hands. He might open the door to the White House just as the economy walks into the next recession, which actually means even though Donald Trump had low inflation under his first term, of course, with COVID policies likely contributed at least somewhat to inflation, he might be defined as somebody who has recession in 2020 and then recession in 2025. And so people might argue Mr. Trump is Mr. Recession. And I think this is how Democrats might try to soil the Trump administration and then take power from Trump in midterms 2 years later as they show, look, Donald Trump's policies always create recessions. Now, that's not fair because the policies that led to inflation and the Federal Reserve to act this way were a dual issue of both Trump and Biden, but also, frankly, probably more so the fault of crazy government spending and the Federal Reserve failing to react quickly enough. But I want you to think about this with me. Imagine this for a moment, because this is a crazy scenario. Imagine this. Trump takes office January 20th, 2025. February jobs data shows negative government and payrolls data. February 7th, just 18 days later, markets freak out that we might be either in a recession, starting a recession, or about to go into a recession. As fears of recession begin to skyrocket, Donald Trump does not implement any tariffs because he would just add fuel to the recessionary fire. Bond yields now plummet and the cost to borrow plummets, leading bonds to skyrocket and stocks to sell off. Unfortunately, as stocks sell off, you end up getting more joblessness. Now, why would you get a bad jobs report in February? Because, well, you're going to get seasonal layoffs, which might be resolved by the seasonal adjustments in the labor report because, on February 7th, we're going to get the January jobs report. We'll see how many people have lost their jobs in January after the holiday season. But then on top of that, what do you have after that? Well, you have a very real potential that election workers are now all unemployed, obviously, and they don't get captured in seasonal adjustments. And now you have this big negative report on top of private payrolls, which are already negative today. Now you really look and say, wait a minute, this sounds like the Federal Reserve and markets might need to start considering the potential for a recession. And that's exactly what the Federal Reserve is warning. In fact, if you look here, the Federal Reserve Bank of New York posts the probability of U.S. recession, and they haven't updated this since September, but it's worth looking at it. Take a look at this. Probability of U.S. September, a recession predicted by Treasury spreads. This is September 2025. So this looks forward to 2025, and it's been looking forward to 2025, frankly, for the last 11 months here. September 2025, 57% chance of recession. This is higher than where we were in 2007 when the chance of recession was 40%, or higher than 2001 when the chance of recession was 45%, and we went into recession each of those times. Every single time this chance went over 30%, we went into recession. Now, you did in, the 90s have a 20 to 30%, 29%-ish, but it's not over 30%. We're at 57% chance of recession right now. Okay, that's not particularly good. So what does that mean? Well, if we end up going into a recession, Donald Trump's tax cut and tariff plan that people and markets think Donald Trump is going to implement will actually end up turning into something else. It'll actually turn into what I'm going to call the Trump Rescue Package and Tax Cut Act. Probably needs a lot of work on the titling there, so let's just call it the Trump Rescue Package. This ends up including tax cuts, hiring incentives for businesses, cheap loans for businesses, personal loan support for financials that might be struggling now, like a SoFi or a firm that are struggling with people not paying back their personal loans, tax credits, potentially new real estate investment tax credits to build homes as the building market slows down and people can't afford housing. It's basically stimulus 2.0. You might even have stimulus checks again. Now, look, this I don't actually think will be enough to be inflationary. That's because Congress will be really cautious about providing too much stimulus because they're going to be worried about inflation. But because we're actually in a real recession that's sort of got a boot on its neck by artificial intelligence, which makes it harder for people to want to hire more people because you could just put existing workers you have to work harder with AI, which makes it harder for businesses to want to hire more and expand. The recessionary deflation that occurs could end up meaning that the Trump rescue package doesn't do enough. It basically just keeps us out of deflation, but it doesn't actually cause any inflation. What instead happens is the Federal Reserve is going to have to cut rates rapidly to 2 to 3%. That won't be enough. And as stocks fall and accelerate the pain, Democrats blame Trump for causing another recession. And then what ends up happening is Donald Trump replaces Jerome Powell in May when his term is up. The Fed gets a new chair that is encouraged to drop rates to zero, which they then do. And the Fed basically fully capitulates under Trump pressure to get us out of a recession. And that could be your most glorious buying opportunity. Not right now when markets are pricing in pure perfection. Right now, markets are literally pricing in pure perfection. The bond market is freaking out over inflation, which is dumb. I don't think that's going to happen. The stock market is pricing in that everything's going to go perfect and nothing's going to go wrong and that growth is going to keep going and there's not going to be a recession. But then when we look at the latest data, we go Q4 GDP estimates have just been revised down to 2.4%. The average 3-month employment growth is just 103,000. Once we start getting to 50 to 80K, we start worrying about recession and really going negative with the total number, which is only positive because of government jobs right now over the last 3 months. The average of the first 6 months of 2024 were 228,000 jobs. We already know the SOM rule has triggered and untriggered, and it's likely to trigger again. If you don't know what that is, don't worry about it. It's just a recession indicator, and the alarm bells have been going off on it. It's the SAHM rule, in case you want to look it up. But what's really important here is it suggests that the trend of deterioration in the labor market is getting worse. Quit rates are really low, which is a recessionary signal. Job openings are really low, which is a recessionary signal. And you're in a position where hiring, it just sucks. Private payrolls are negative. Anybody out there trying to get a job right now knows how hard it is to actually get a job right now. At present, at the time of this recording, the yield curve is about 18 basis points uninverted. Now, again, fancy finance math here. The point here is just to say that we're getting closer to a level of uninversion that is recessionary. Usually when you get to between 50 to 90, a lot of pain happens because something starts breaking. You end up having another banking crisis, another Japan, or, some form of financial market correction. Who knows? Nobody knows what it's going to be. Just recognize that the recipes are set. We have a tinderbox full of dynamite ready to blow, basically. And unfortunately, if it blows up in Donald Trump's face, Donald Trump's going to get blamed for it, even though it's not his fault. Now, the job report, coming up in February or even just over the next few months will be closely watched. But the Federal Reserve is likely to move too slowly to make any big difference until Donald Trump is actually in office. We do have a Fed meeting tomorrow, which I'll be covering. Make sure if you haven't yet, sign up for the Alpha Report. Go to meetkevin.com/alpha. Get a free report on my thoughts on trades during the day. Or for the day leading up, trend lines, resistance lines, volatility estimates, where valuations are high, where valuations are low, my thesis on catalysts coming up and otherwise. Obviously, it's not personalized advice, but I encourage you to check it out. But really, you have to understand this. The Federal Reserve, by tomorrow, will have cut interest rates by 75 basis points. Yet markets tightened yields by 80. So in other words, the Fed is like, hey, things are softening. Let's make things cheaper. And markets are like, haha, let's make things more expensive by basically the same amount. That's really bad because you just basically restricted the economy even more. And when those high rates actually hit the economy, which probably takes 3 to 6 months, surprise, surprise, brings us back to Q1, the first half basically of 2025, right when Donald Trump walks into office, you probably end up in a recession. The Federal Reserve says it's more likely than a coin toss at this point. It's more likely than not. So what do you do? What do you do in a scenario like this? Well, in my opinion, there are a few things that you should do. And first of all, keep in mind, if you need personalized financial advice, I can't give you that on this channel because I don't know what your situation is. We do have an option for you. You go to stockhack.com and you can actually get personalized advice. We look at your situation and help you figure out exactly what to do and what's best to do for your situation. But let's think about this for a moment. Something to consider in the event that we are going into a recession is building a larger emergency fund, something that's going to enable you to buy that stock dip when the Federal Reserve capitulates, and something that's going to be able to let you float through potential job loss over the next 2 years. And I'm not saying you're going to have your income go to zero, but your income may fall. Let's say right now you're making $125,000 a year, either by yourself or with your spouse or whatever. What are you going to do if that goes down by 30%? What if your monthly budget was 30% tighter than it is today? And if today you're living paycheck to paycheck, imagine being another 30% down. So I'd rather start thinking about how do you build more insulation for yourself? Do you do more side hustles? Do you take more shifts while the economy is still decent? We're not in a recession right now, but do you take more shifts and build more money now? Do you start setting trailing limits on some of your stocks? Maybe you say, hey, all my stocks are going up. This is great. Okay, that's totally fine. So maybe what you do is you set a wide trailing limit. Hey, sell Tesla if it falls by $40. Okay? Well, great. If Tesla keeps going up, it doesn't sell. But if you have a trailing good to cancel limit of $40 and it runs to 320 and then it goes back down to 380 or 280, boom, it triggers a sell. It's just an idea. So maybe trimming a little bit of exposure from stocks, but also minimizing your debt, not taking on more debt during this sort of environment, paying down debt that you have so that you have available borrowing capacity if you need it in a recession when things get tighter. And something to really consider, if you have equity in your real estate right now, consider getting a home equity line of credit. Really good idea, in my opinion, to get a home equity line of credit now when valuations are higher. Because if valuations do trend down, you don't want to be in a situation where now you can't borrow anything. You don't have a credit line anymore. This doesn't mean credit lines can't be frozen. They can be, but I think it's better to have and not need. You don't have to borrow from it. You don't have to pay any interest on it. You know, let's say you have 100K in equity in your home and you have an 80K credit line you're able to pull on it. And just have it at least open. You know, that way if there's, some market crash or whatever, you've got an insulative blanket that, you weren't even paying any interest rate on or any interest expense on. So these are just some things to keep in mind, some things to consider. But this right here is exactly the playbook for how Democrats could destroy a Donald Trump presidency. Recession. And it wouldn't even be his fault. But I look forward to covering the Trump rescue plan. Anyway, subscribe to the channel if you like this sort of insight, and we'll see you in the next one. Thanks so much, folks. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.